Everyone says VOO beat SCHD by $92,000. I checked the numbers myself, they're wrong. Here's what I did. I took $100,000 and put it into VOO. That's Vanguard's S&P 500 ETF. 500 of the biggest companies in America in one fund. I let it sit for 10 years. Dividends reinvested, didn't touch it. Then I ran the exact same test with SCHD, Schwab's U.S. Dividend Equity ETF. 103 companies that pay growing dividends year after year. Same 100,000, same 10 years, same rules. Here's what happened. VOO turned that $100,000 into roughly $403,000. SCHD turned it into roughly $338,000. The real gap is about $65,000, not $92,000. Now, $65,000 is still a lot of money. That's a new car. That's 2 years of college tuition. But it's not the $100,000 disaster story the internet keeps repeating. And here's the thing. What caused that gap is way more interesting than the number itself. Before I show you, take a guess. What do you think created that $65,000 difference? Was it fees? The stocks inside each fund? Something else? Drop your guess in the comments right now. By the end of this video, you'll know 3 things: what actually created that gap, the hidden tax cost that makes it even wider in the wrong account, and the one framework that tells you exactly which ETF fits your life right now. And the part that surprises most people, it has nothing to do with which fund is better. It's about where you hold it. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, if you're in your mid-30s or early 40s, this one hits different. You've probably got a mortgage, maybe kids, a 401k you've been contributing to but haven't really looked at in a while, and now you've got some real capital to put to work. That's exactly the stage where this decision matters most. VOO or SCHD? Growth or income? Let's settle it. 7 stocks did all the work. So now you know the real gap is $65,000, not $92,000. But where did it come from? Here's what most VOO versus SCHD videos won't tell you. Almost all of that gap came from 7 companies. VOO holds about 500 stocks, but the top 3, Nvidia, Apple, and Microsoft, make up nearly 19% of the entire fund all by themselves. Just 3 companies holding almost a fifth of your money. Add Amazon, Alphabet, Meta, and Broadcom, and over 30% of VOO sits in 7 names. SCHD holds 0 of them, not 1. That's not an accident. SCHD tracks 103 companies that pass strict dividend quality screens. Names like United Health, Chevron, Coca-Cola, Home Depot, PepsiCo. Solid, boring, cash-generating machines, but none of the mega-cap tech stocks that exploded during the AI boom. And that boom is where the gap opened. Between 2023 and 2025, those 7 tech stocks had one of the biggest runs in market history. VOO gained over 26% in 2023, almost 25% in 2024. SCHD couldn't keep up because it was never designed to. But here's what people conveniently forget. Go back to 2022. The Fed was raising rates aggressively. Tech stocks got crushed. VOO dropped over 18% that year. SCHD down just 3.26%. That's a 15-point cushion in a single year. Big difference. And right now, in 2026, guess who's winning? SCHD is up roughly 20% year to date. VOO is up about 9%. The cycle is already turning. So the gap isn't some permanent rule. It's a story about 7 tech stocks in 3 unusual years. That story could look very different next decade. Here's what I want to know. If you had to put $100,000 into just one of these for the next 10 years, are you Team VOO or SCHD? Tell me in the comments. Now, before you decide, there's something about SCHD that changes the math more than you'd expect, and it has nothing to do with stock prices. The income that grows every year. VOO won on total return, no argument there. But SCHD does something VOO simply can't match. It pays you real money every quarter, and it pays you more every single year. Right now, SCHD yields about 3.14%. On $100,000, that's roughly $3,140 a year, about $785 hitting your account every quarter like clockwork. VOO pays dividends too, most people forget that, but its yield is about 1.1%. That's roughly $1,100 a year on the same $100,000, less than a third of what SCHD delivers. Now, here's the myth that trips people up. Here's the myth. Dividends are free money on top of your returns. Here's the truth. Dividends come out of the stock price. On the day a dividend is paid, the share price drops by exactly that amount. What matters is total return, price gains plus dividends combined. And on that score, VOO won the decade. Dividends aren't a bonus. They're one piece of the total picture. But, and this matters, SCHD's dividends grow fast. Let me think through this out loud. Over the last 10 years, SCHD has grown its dividend at roughly 9% per year. So year 1, you're getting about $3,140. By year 5, let's be conservative and call it 7% growth, you're closer to $4,400. By year 10, around $6,800 a year. From the same investment, you never sold a share, you never added a dollar, the income just grew. And every dollar SCHD pays you is a qualified dividend. That means you don't pay your regular income tax rate on it. You pay the lower capital gains rate, 0, 15, or 20% depending on your income. For most people earning a solid salary in their 30s and 40s, that's 15%. Quick question before we move on. Do you currently own VOO, SCHD, or both? Drop it in the comments. I read every single one. That growing income sounds great, but there's a cost hiding inside those quarterly deposits, and it makes the real gap between VOO and SCHD even wider than $65,000. Most people have no idea it even exists. The hidden tax nobody talks about. I think most people get the SCHD tax question completely backwards, and I know some of you will disagree with me on this. Here's the problem. Every time SCHD pays you a dividend in a regular taxable brokerage account, even if you reinvest every single penny back into the fund, the IRS wants their cut. You owe taxes on that money, whether you spent it or not. Let's run the numbers. Your $100,000 in SCHD pays about $3,140 a year in dividends. At the 15% qualified rate, that's roughly $470 in federal taxes every single year. $470 doesn't sound like much on its own, but remember, those dividends grow at about 9% a year, so your tax bill grows right along with them. Over 10 years, you're looking at roughly $5,000 to $6,000 that left your account and went to the IRS, money that could have been compounding for you. Instead, it compounded for the government. Now, look at VOO. Here's the difference. Most of VOO's return is what they call unrealized capital gains. That just means the money grows inside the fund and you don't pay a single dollar in taxes until the day you sell. Your gains compound completely untouched for 10 years, 20 years, 30 years. You choose when the tax bill comes. So, in a taxable account, the after-tax gap between VOO and SCHD is wider than $65,000 once you factor in that drag. But, and this is the part that flips the whole debate, that entire tax problem vanishes inside a Roth IRA. Think about it. In a Roth, you already paid taxes on the money going in. Everything that grows inside, every dividend, every dollar of appreciation is yours, tax-free, forever. No annual tax bill, no tax when you withdraw. SCHD in a Roth means quarterly cash deposits that get bigger every year and you never owe a dime on any of it. Same fund, same yield, totally different outcome depending on which account holds it. SCHD in a taxable account has a silent tax drag eating your returns. SCHD in a Roth is a tax-free income machine. And once you see that, the whole VOO versus SCHD argument changes, because the real question was never which fund, it's which account. So, which one wins? Here it is. VOO wins on total return. Over the last decade, $100,000 turned into $403,000. If your only goal is growing your money as fast as possible and you don't need income today, VOO is your answer. SCHD wins on income and stability. It pays 3 times more in quarterly cash. It grows that payment by about 9% a year. And when markets fell apart in 2022, SCHD barely moved while VOO dropped 18%. But the smartest move, you don't pick one. You hold both and put each one where it works hardest. Here's the framework. Simple. VOO goes in your taxable brokerage account. Growth compounds without triggering annual taxes. You pay nothing until you decide to sell. Maximum compounding power. SCHD goes in your Roth IRA. Dividends become completely tax-free. No annual tax bill, no tax when you pull it out in retirement, just a growing paycheck that costs you nothing. Now, the split depends on where you are in life. In your 30s, tilt heavier toward VOO, 70 to 80% growth, 20 to 30% income. You've got 20 plus years of compounding ahead. That time is your biggest asset. Don't waste it chasing yield you don't need yet. In your early to mid-40s, start blending in more SCHD, 60-40, maybe 70-30. You're getting closer to the decade where that growing income stream starts covering real bills. Let the barbell do its job, growth on one end, income on the other. The point is, you don't have to pick a winner. Smart mid-career investors play both sides. They just put the right fund in the right account. If someone you care about, a friend, a partner, a sibling, is trying to figure out where to put their money right now, send them this video. This is the part they need to hear. And here's what I want you to remember. If you write down one thing from this whole video, make it this. It's not which fund you pick, it's which account you put it in. Same 100,000, same decade, wildly different outcome, all based on where you hold it. That's the whole game. If someone you know is trying to decide between VOO and SCHD right now, share this video with them. I want to know, what's your current split? Are you all VOO, all SCHD, somewhere in between? Drop your ratio in the comments. If you're building wealth through dividends and want to keep making smart moves with your money, subscribe to this channel. We break this down every single week.